Hello everybody, Jackson here with the Wealth Squad. Today we'll be talking about the latest correction in the stock market. So as you may know, tech is getting destroyed. And this is not, something new to the stock market. Back in 2000, 2001 when the dot-com bubble burst, um, many stocks went from, 100 to $1 or $2, right? Down 99%. What we're seeing here is almost no different in terms of more tech type stocks. Now we're not seeing negative 90, minus 99% returns yet. We're seeing 40 to 60, right? 40 to 60% less than what they were about a year ago or a couple months ago. We're checking on Facebook, one of the largest stocks, right, in the top 10, or at least was. We're checking the year performance, right? We're seeing 260, and then it hit 380, almost 400, and then it hit 200, right? We're at $200 for Facebook. Now we check out the all-time chart, and you can see this large candle, which we have never seen before, right? We talked about earlier about how Facebook was a good buy. These corrections all pointed to Facebook bouncing, but it has yet to bounce. Check out the log chart. This is simply on a percentage type performance rather than dollar, right? We're seeing this candle go from 314 to 200, right, down $100. But this candle's the same size almost, and you can see it went from 42 to 29, right? It's not a $100 difference, but it's the same percentage, if that makes sense. On the log chart, we're seeing the largest correction since July of 2012, a couple months after it went public. This is Facebook, right? Let's check out PayPal. We're just doing this to see the severity of these stock corrections, right? We're seeing, are they actually, is this nothing or is this something? And I think it's something. Checking Facebook, or I'm sorry, PayPal, largest drop in history. Netflix. Well, you can see Netflix has a lot of volatility. Past all time has gone from $1 to 500. This Netflix has definitely been in worse situations when it went from 32 to 8 back in 2011. I'm sorry, Netflix, if I said Facebook. But the past 5 years, this is the worst that Netflix has seen. And Netflix is also, one of the bigger ones. Now let's check on stocks not necessarily affected by the earnings crash, but more affected by the general market. Microsoft, not too much news coming out of Microsoft lately, but it is still one of the biggest stocks in the market, which means it is affected by these drawdowns that everything else is going through. Microsoft down a reasonable amount, nothing crazy, down 18% from the highs. You can see over the past year on the log chart basis, this is the biggest correction past 5 years. Not so much, right? We can see during COVID went from 185 to 130. We're only doing 340 to 280. So nothing out of Microsoft. Apple, same thing, nothing. COVID was much worse for Apple than what's happening now. It's barely moving. So the biggest stocks aren't moving. The smaller stocks are tanking, right? Let's see the worst performing stocks year to date. Over a market cap of 10 billion in the US, we see Affirm, which was a darling stock at 180, now a failing stock at 35. Roblox, darling stock in the hundreds, now 45. Carvana, darling stock in the 300s, now 100. Let's actually look at that one some more. Yeah, you can see Carvana has been through worse just because of COVID, right? On the auto basis, it doesn't look like it, but on the logarithmic basis, it definitely is apparent. We got Roku, Etsy, PayPal, which we looked at, Moderna, we looked at Square, which is now under 90, once 250 consistently. Even on the logarithmic basis, it still looks like this is the worst crash it's seen. Let's check out percentage. We got 66 from the highs, 68 with the COVID crash. We saw 64, 63. So this is the worst that Square has ever seen in its couple years, right? 2016 went public. Rivian, Palantir. A lot of these stocks are, products of this bullish environment. A lot of them are not, right? We have PayPal and Square are obvious finance stocks that have been around before this latest boom in the market. Netflix, of course, Facebook, obviously. Those are, solid stocks to walk behind. The others are a little scary, like Affirm, Roblox have just went public in the last year or so. Roku, a little longer than that, but still relatively new. Moderna has to do with, not tech, so I'd rather stay away. Twilio, DoorDash, AppLovin, um, Lucid, which is another electric car manufacturer. You got Wayfair, Pinterest, Chewy, Zoom, Unity, which is still not even too cheap, right? Unity at under 100 is not even a deal, right? You still have prices back in May that are better than what Unity is trading at right now, even though it's a obvious tech stock. So some stocks are hurt. Most are. DocuSign hugely crushed. Cloudflare destroyed. Coinbase destroyed. MongoDB destroyed. Teladoc destroyed. Ring Central destroyed. What I'm trying to say here is that this is not a crash to brush off. This is something that is very real. It may not last forever, but the deals that are here right now for sure won't. There's a lot of good deals in the market, but you should just be cautious because a lot of stuff could keep going down and go to zero. It's truly possible. Let's look at Skills. This stock was, we traded in the Wealth Squad actually. Thankfully traded, not invested. So Skills was a tech stock, and you could see if it'll tell us. Well, after hours, it went below 3, right? It fell 25 or so percent because of a missed earnings report. Skills crushed, right? Roku, once $400, $500, now hovering above 100. We got Etsy, where you looked at Pinterest, now below 25, and this was the price before COVID, before it hit 90. It's back to the IPO price. So a lot of stocks erased all gains, right? It's truly hard to comprehend that. Let's look at the QQQ Holdings, the tech index. You can see all down at least 1 or 2%. Some aren't even tech, like Pepsi, and Honeywell. It has more to do with food and oil. But most of them are tech. And Tesla down 6%, Nvidia down 4%. Those are one of the biggest gainers in the past couple of years. Let's check out Nvidia. Logarithmically, it's been through worse, right? You see 2018 went from 73 to 30. Back then, it was a different price, of course, before the split. But right now, we've seen 340 down to 200. Still not a terrible crash compared to everything else. But this is the time to start averaging in. If you aren't new to investing, then you've seen this before, where it's 2-3 -% each day. That's just further, to your advantage because you're getting in at a cheaper price every single day. Averaging in for sure is the best thing to do. Don't dump it all in one lump sum. Funny enough, I thought about putting all into Facebook the day it crashed because, looking back, Facebook has been a solid stock in the past couple of years. But I'm glad I didn't. Right now it's under 200, and now I'm going to start averaging in because usually you wait a week or two and you get a better price in this market, at least after a crash. So we're going to see what's going to happen. It's very exciting. Definitely a money-making opportunity because money is not made in the bull markets. It's made in the crises, right? it's made in the bear markets. That's where you can load up and sit on your shares. That's what I recommend you doing. Start loading up, start averaging in. That's the best thing to do in this scenario. So I hope this video helps you make some money in the long term. I hope you buy some stocks and get that money invested. Have a great day.